A zero indicator strategy only using boxes. This is how this box strategy is going to work. Let's consider if this is price and it is reaching to this level at the top or area of interest. Then over here, we're going to enter trade based on this box model. And similarly, if the price is reaching to the bottom of this box, then we will initiate the entry. To set up your chart for box strategy, you're going to need a vertical line and mark the 1700 hours of previous day. After that, pick one more vertical line and mark the 1700 of the day before. Once you're done marking the vertical line, next up, pick the rectangle box tool and start drawing from the left vertical line. Then you also need to make sure to include any top and bottom wicks and stretch it all the way towards the right vertical line. This box marks our previous day, but after that we need to pick the rectangle tool again and mark the future day range using previous day highs and low. Let me show you. After marking the future box, make sure it is aligned plus give it a different color. Then we're gonna need to box swing points. These swing points are marked as box areas within the box, which we then gonna use as areas of potential opportunities for the next day. To mark the areas, we're gonna start from this wick and stretch it towards the next wick. However, we can see the next green wick is already touching the box range, so we're gonna ignore that and select this intraday red wick. Along the same line, we're gonna mark upper area starting from this last candle by including intraday swing points towards the left side. Stretch both areas to the next day and our box strategy setup is ready to use. And always we're gonna ignore the first hour. Here the price has reached to our area of interest and it has shown a reaction, which means there is a potential entry. The keyword here is potential entry, meaning do not enter trade blindly without confirmation. Therefore, you need any type of entry model. So for this example, I'm gonna show you to go down to lower time frame. Once the price has reached to area of interest, go down to 1 minute time frame and draw a trend line. If you notice that the price has broken the trend line or it has crossed the recent swing high, then it is confirmation to enter trade. Set your stop loss below swing low and take profit halfway and keep the rest running until it hits the upper area. Now that you know how to enter trade, you can use the same concept of entry method to get short here. In addition to that, if we let this trade play for the day, some visible opportunities will show up like this. Notice how price is behaving around these areas of interest and respecting the box. But there is a problem when previous day's price end up staying one-sided like this. Notice how price is bearish. In this case, we're going to mark our next day as following. Firstly, copy the box from previous day and drag it over to the next day. Then change future box color to anything. I like to keep it green. After that, look at the price action on previous day and notice how there are visible pivot points. These pivot points are going to be the areas of interest in the future. To mark these areas, pick up the box tool and start marking them, considering the average body candle. But if you're not sure what size you should mark, then use ATR indicator to find average price range. Here the third pivot point is very weak compared to the others because it has already been wicked by the second pivot point. Our chart is ready. Let's play this. Right after 1 hour, the price dropped below the box. Now in this case, we do not enter trade. In fact, we want the price to retest area around the box, and the price must not cross and close inside the box. As it is evident, the price failed to hold outside the box. So moving on. However, on second occasion, the price is holding near the box, but there is a problem. Notice how the green wick failed to form a body. That shows it has swept the liquidity on previous pivot point outside of the box. This will be considered a conflict. Therefore, we will not enter a trade. Moving on. As the price is approaching to first area of interest, we still need some sort of reaction and to confirm the entry. Here, this red engulfing candle is the confirmation to enter short. This is a potential entry to go short, keeping the partial target around box edge, and let the rest running by targeting swing points outside of the box. For the next day, simply drag previous day's box in front of current day. And also adjust current day's box as per current swing highs and lows. However, leave the areas of interest untouched. Our chart is ready and we hope to see some reaction near the box edges or around the areas of interest. Near the bottom, price is struggling to move to any direction, but we're not going to enter long without any confirmation. So this spike along with the big body of green candle is a confirmation to go long. So we can enter the trade with partial profit and let the trade run to the areas of interest. But if you want a simple approach, instead of this box strategy, you should apply this one candle method on your chart.